of these tankers off the Dorset coast, weighed down with fuel, choosing not to come into port to unload their cargo. Now, these pictures you can have a look at now have been sent to us by our colleagues at Spotlight in the southwest. They show similar scenes back in April, so they've been there for months. So what's the truth of the matter? Is it rampant profiteering by oil firms at the expense of the motorist, or is there something else going on? Well, with me to explain is Simon Wardell, who's an oil analyst, oil expert with Global Insight. Morning, Simon.
Morning.
So, are they just holding out for the prices to go up and then they're going to bring in its profiteering? What's going on? What are they doing there?
Well, it's more a consequence of the oil price structure than a cause of it. I mean, at the moment, we have spot prices which are low compared to...
Spot price is the price today to
That's
actually
right.
buy the
That's
physical
right.
stuff.
The spot price today, the oil price today, is much lower than the price for delivery in 6 to 12 months' time. So what oil companies can do is they can sell oil forward. They can, in other words, they can sell it for delivery in 6 months' time, and they can buy it today on the spot market much lower. Now, if the difference in price is lower than the cost of storing oil, it's an easy trade to make. And
so what you're saying is that the oil price, 1 year from now, you can buy oil in the future.
Yeah.
That is much more expensive than oil is now. Why is that, though?
Well, markets are expecting demand to rebound. They're expecting the economy to improve. They're expecting demand from Asia to increase. And they're concerned about supply in the future. As we saw just recently in 2008, we had very high oil prices. So they're concerned that when demand comes back, we're going to have a shortage of oil. So what the market is doing is sort of spreading out supply from a time now when we have excess to a time in the future when we won't, or the market thinks we won't.
So they're having to pay much more to lock in supplies in the future, and so that you can buy it now, sell it today for delivery in the future, and pocket the difference.
Exactly.
Well, what is all this going to what impact is this actually having on, for example, refineries and the cost of petrol?
Well, on the cost of petrol, it is pushing up the spot price a little bit, so it is pushing up the price today. But it is also probably going to mean that we won't have price rises in the future as high as we might have otherwise had them.
OK, this difference between the price now and the price in the future, presumably if more people do this sort of thing, then the price in the future will come down and the price of it now will actually go up, so it won't be worth doing.
Yeah, it comes in waves, and every now and then this activity of buying in the spot and selling forward, it flattens that forward curve and it closes the possibility of making that trade.
OK, so it's a question of demand and supply now and demand and supply in the future.
Exactly.
Simon, thanks for explaining that. We're going to be having a look at what that means for petrol prices. Diesel's over £5 a gallon. What does it mean for you, the motorist? More from me later.